Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Wednesday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, today we're going to go over the overall portfolio, how the individual stocks are performing, what growth stocks are on my watch list, and some ideas that I have that if I had extra cash, say 10 to 20K, which is I know is a lot of money, but if I had a chunk of change ready to deploy into the market, where I would be putting that money. So jumping right in for today, we are up over $600, up 1.23%. Then on the 1 week mark, we are up $800, up 1.6%. The 1 month mark, we are up $1,675, up 3.3% for the past month. 3 month mark, we are up $5,214, up 11.12% in the past 3 months. Year to date, we are up $2,200, or up 4.5%. For the 1 year mark, we are up $1,378.12, up 2.72%. And then all time, we are up $16,760.37, up 47.5%, almost 48% total, all time since 2018. We have a buying power of $86.89. That's just going to sit there, and I'm going to accumulate more cash to buy more deals as I'm not adding cash currently to my portfolio and paying off debt. Next, we're going to jump into the individual holdings, starting with Realty Income. So for today, it's down 30 cents. Not worried about short-term fluctuations. We have 170 shares, $8,800 worth of market value. Average cost is $65.03. 17% of the portfolio is in Realty Income. Today, we're down $51, or 0.5%. Total, we're down $2,222, down 20%, with a dividend coming in on the 15th, which is in the next 10 days. So I'm excited about that dividend, and it's going to grow because I bought the last 4 shares to get it to an even 170 after the ex-dividend date. So my next month's dividend will be higher than $42.58. So that's awesome. The dividend's already growing just because I added a little bit with my dividend income. So next, guys, we have Coca-Cola. This is one of my foundational stocks. I love this company. It is one of my absolute favorites. It's something that I consume every single day. I love Coca-Cola. The Coca-Cola 3000 flavor and the new raspberry flavor that they put out. Or it's not raspberry. It's spiced is the flavor. But it's so good. So I love the innovation of this company. It's a timeless brand. And I pick it up at the store every time I go. So love this company. Originally, the goal for the year was to get to 100 shares, but given my financial issues right now, I'm not able to deploy as much cash into the stock as I would like. That's okay. I have my whole life to put money into the stock market. I'm going to get out of debt first. That's going to be super aggressive. I want to be debt-free by the end of the year. And then I will be pouring money into positions that make sense. So as of right now, I only have 15 shares of Coca-Cola, right around $900 of market value. Average cost is $60.54. 1.17% of the portfolio is in Coca-Cola. Today we're down 37 cents. Total we're down right around $16, or down 1.75%. Again, not worried about it. This is one of those companies that fluctuates, but it doesn't drop down a lot. You need something drastic to happen to the overall market or to the individual company in order for Coca-Cola to drop. So I'm going to be patiently waiting. If it drops below my average cost like it is right now, I might nibble on a couple of shares, get a few when I can. But I'm not in the accumulation stage for myself right now. I am in a paying off debt stage. Next, we have got Altria, which was down big, but it popped back up today. So 320 shares, $13,000 of market value. Average cost is right around $47 per share. Portfolio percentage is about 25.5% of the portfolio is in Altria. We are up $480 today, up 3.74%. Total, we're still down nearly $1,900, or nearly 12.5% on Altria, and I'm okay with that. This is one of those that it's a company that I used to use, so it's kind of in the same vein as Coca-Cola, but I don't smoke anymore, so I figured put a decent amount of cash, a decent chunk of change that I had in the company, let it pay for companies that I think are higher quality, while this dividend grows. Guys, originally when I bought the company, the dividend was like 84 cents. Now it's 98 cents, and I haven't added for a while. So this is one of those slow, dependable growers. I know that the stock does not appreciate very much. As you guys saw yesterday, the stock was down. Over the past year, you would have lost $5. Not a huge loss, honestly, but the dividend keeps growing, and you can allocate, if you can allocate that dividend capital smart into better businesses, then I think it pays for itself over the long term. And as I said, I was a smoker for a couple of years, so I just wanted to get a little cash out of an investment that I definitely spent more than, my monthly payment of $300. I guarantee you I spent more than that on cigarettes over the course of my lifetime. So I figured, why not put a little bit of cash into a sin stock I funded and, take some of that money and put it into something better like an Apple or a Visa eventually. And that's really the goal with the Altria position, is to take the opportunity to take those growing dividends and put it into something that I believe will grow more than Altria. So I'm happy to buy myself, a share or two of Apple with these dividends. I'm glad to buy a share of Visa or a share or two of T. Rowe Price. So that's what this is. This is a catalyst for me to propel my dividend income further. I'm using their cash flow to buy higher quality companies. Next, we've got Apple. This, in my opinion, is the highest quality company in the entire world. Love it. I wish I had 1 million shares of it. I was a little late on the Apple wagon. I mean, I've had an Apple device. I have an iMac. I've had an iPhone. So I understand the ecosystem. I understand the customer loyalty. I just missed the boat. I was dumb. I hesitated, and I shouldn't have. I owned them in like 2018, and I only owned one share, and here I am owning one share in 2024. So I made a mistake. I should have bought more. Speaking of mistakes, I only have one share. My market value is $169, but my average cost is $132.66. So guys, this is one of those that I just bit the bullet. I bought it when I got paid a dividend. I believe it was probably a Altria dividend. Bought a share at about $133, and it's gone up since. So I haven't added anything since, but I do want this to be the biggest position. I want it to be Apple, Visa, and Coca-Cola to be the three biggest positions when it comes to dividend paying stocks. So right now the portfolio is only 0.32% of Apple. Today we're down $1. Total we're up about $37, or almost a 30% return. 28% to 30% return on Apple. And like I said, guys, this is going to be one of the largest positions, if not the largest position in the portfolio, given that it goes down in time. I want to have a cash pile to be able to buy more shares. I'm not in that position currently. But mind you, if it drops to like 130 or 128, I'm going to be buying it up as much as I can. So this is one of those that I'm happy to hold it. It's a high quality company, one of my favorites in the entire market. I understand the business model, and I plan on buying more. It's just not the right time for me given the price. Then we've got the biggest player in the portfolio, AbbVie, ticker symbol ABBV. Now they're sitting at $181.84 today. I have 95 shares. Market value is $17,272. Average cost is right around $95 per share. That originally was at $88, but I bought 15 more shares a couple years ago, and I just wanted more of the company. 33% of the portfolio is in AbbVie. Today we are up about $250. Total, we're up $8,225, have a near 91% return on AbbVie. Gotta love that. This is one of those arbitrage deals, one of those classic Buffett / Benjamin Graham deals where I saw a company being acquired and I jumped into it. There are other opportunities in the market like this, just like Microsoft bought Activision and they bought it at a premium, just like Kroger is buying Albertsons. There's always a company being acquired, and if you can get in on that deal and it goes through and it makes sense for your portfolio and they're buying it at a premium, which they usually do, you can lock in those gains. Now the difference is I believed in AbbVie long term and I held it. I didn't just buy it for the acquisition and sold it at a handsome profit of, I believe AbbVie at the time was $88 and they were buying Allergan. It was like 140. Say they bought it at 160. So I bought AbbVie, which would have been the company that was purchasing, not being purchased. Most of the time when you go for these deals, you're going for the purchased company. But long term, this did pay off, guys. I have a 90% return. I love AbbVie. This is my single biggest and best investment that I've ever made. And honestly, if I had free cash, I have companies that are on my watch list that would be just like an AbbVie situation. And so I want to keep looking for those types of deals, those types of opportunities. And given the fact that once I pay my debt off, I want to jump into those and make a handsome profit. Now, sometimes that doesn't always mean that I'm going to believe in the company long term. So say like, I don't know, Tyson Foods buys another meat manufacturer. I don't really believe in Tyson Foods, but if there's a premium that they're buying the company for, I'll sell it off, take the profits, and put that into something I believe in more. So I want to look out for some of these deals. If you guys see any of these deals, let me know. I know Albertsons being acquired by Kroger was one of the big ones that people were talking about. But I want to look for more deals like this because I've fallen in love with that type of return. A 90% return is phenomenal over the course of 4 years. Now, T. Rowe Price, this is another one of those that I think has an AbbVie potential because I have 100 shares, $11,667 worth of market value. Average cost is sitting right around $110 per share. 22% of the portfolio is in T. Rowe Price. Today, we're up $41. Total, we're up nearly $700, up 6%. So, guys, this company has been down for a long time. Year to date, it's only up $9. For the year, they're only up $2. So if you bought this, in 2022, you're pretty much break even on it, plus the dividend. So odds are you're coming out ahead because it's the dividend and the growth. But that also provides an overall return, meaning you probably are, positive overall on the return. But the reason why I'm so excited about this is because I have this company at around 110 per share. If you look at it long term, not just within the past year, if you look at it within the past 5 years, about the time I was looking at originally purchasing it was around 2021. So I bought and sold this. I went into VFC Corp, which I've talked about in the past, and I did buy Tyson Foods and sold out of it as well. So I'm not perfect, guys. I make mistakes, but this is one of those that I want to hold long term. If you constantly are like buying and selling out of a good company, you're going to get bit. So I just decided, screw it. It's better to just own the company outright. So the reason that I think this has the potential to be an AbbVie situation is because I bought it at 100. It's at 116, right? But the real high of this company is around $220. So I have about a $100 upside on 100 shares. So on a $10,000 investment, I'm looking at a $10,000 upside. Plus, I locked in that, say, 4% dividend. So I have a $100 upside per share, given the full 52-week high, or I guess over the past 2 years, because the 52-week high now is 126. But I feel like that is a little bit, I don't think that represents the company. It's a little bit off kilter because it was 226. I believe that given the economic issues that have happened, the ups and downs of the economy, the political stuff that have been going on, and overall the shift in their business, as in I use Robinhood. I don't use T. Rowe Price, right? I use Vanguard for my 401k, but I don't use T. Rowe Price. So they have a little bit of an overall shift in their business, but they still are allocating capital at a high rate. They get a high rate of return. They know where to put that money to keep growing the business and rewarding shareholders with a growing dividend. So this is a golden goose, in my opinion, for my portfolio, because even though the returns aren't great in the past year, that's not how I'm looking at this company. I think over the next, say 3 to 5 years, I'm 28 right now. By the time I'm 30, as long as I buy and hold this company, I'm going to rake in that 4% dividend, which is actually a little higher for me because I bought it at a lower price. And I think overall, I could be looking at a 50% return given the next 3 to 5 years. Of course, things change, right? I could be wrong. It could go down to like $70 or $80 a share. If that happens, I'm buying up more. I love this company. I believe in it long term. And I do think that this is going to be a growth catalyst for the company. I know that there's been a couple of questions that I've gotten on Instagram and comments even about why I don't hold just pure growth stocks like Amazon, Facebook, or say Nvidia. That's because I don't understand AI. I understand how to invest. I understand how these companies work. I've read books on how mutual funds are started, how they progress, and the downfalls of the fees that they charge, which is exactly what T. Rowe Price does. I don't believe in owning a ETF or an ETF because I think there's too many, a mutual fund, not an ETF I do believe in, of course, S&P 500, that kind of thing. I do believe in that. But if you read the Investing with the Wolf of Wall Street, investing like a wolf, you learn about how the mutual funds, not the ETFs, but the mutual fund industry is so sideways because they're not worried about the profit for their investors. They're worried about the profit for themselves and the fees that they can generate based upon the assets under management. So I don't like the fee structure of the overall industry. But if people believe in T. Rowe Price enough that they own the company and they own their assets and they can beat the market over the long term, or just believe they can beat the market, I'm willing to profit off of that. So I think that this could be an AbbVie situation, and I just need to be patient and rake in that dividend, reinvest it, and see where it goes. So I could totally be wrong on T. Rowe Price, but as of right now, it's growing. I know the economy's growing. I'm not super worried about it. I'm going to sit pretty with my overall return sitting at what, like 7% for the past 3 months. Give it 3 years and we'll see where I'm at. So guys, that closes out the actual portfolio, but I did get some questions the other day about what's on my watch list. So I do have Visa on my watch list, guys. This is one of these no-brainer companies. I use it every single day. Honestly, it's going to be one of the bigger positions in the portfolio. I just don't have the cash to allocate towards Visa right now. But given the fact that I'm going to get some dividends, I get dividends every single month. I get an average of $170 per month. So this month is March. I'm going to get $122 from T. Rowe Price. That you saw that $42 earlier. So I will not make enough in dividends this month to buy Visa. But in time, I will get paid a dividend that covers Visa. So I will add that relatively soon. And it's just a company that I love. I understand the business model. I use it every day. So that's one of those that I'm going to be making a very big position. The only issue that I have right now with Visa is the price. Now, this is, you could argue, is just like a Costco or a MasterCard or an Apple. Sometimes it's better to just bite the bullet and buy the stock. But I don't think that buying it at this price is a smart move. I want to wait a little bit. So the 52-week high of this company is 286, so it's $6 off its high. Its 52-week low is 200. So if I could get it around 220, I'd buy it. But given that it's so close to the 52-week high, I don't want to touch it right now. But it will eventually, it will go down. And when it does, just like I said with Apple, I want to have enough cash stored away that I can put $10K into Visa and just let it compound. So then, guys, the last thing that I wanted to talk about here is my growth-oriented positions. So I want to add these because I want 10 stocks in the portfolio. There are, of course, other options that I'm looking into for an arbitrage deal or for stocks that I think are down big that could have the potential to rise, like, say, an AbbVie situation. Those would be like Hershey, Dollar General. Those are the two that I've been looking at. I looked at PayPal a bit. I don't understand that business as well as I understand something like a Hershey, so I didn't feel comfortable putting my money into it. But there are other opportunities that I've been looking into. The only issue that I have with those is I don't like selling the stock, right? I don't like having to pay taxes on those gains. So that's partly why once I find a company that I really like, I want to hold it. Even though companies like or Realty Income or Altria are down, I believe in those for the medium to long term. So I don't want to sell those. Even though I'm up big on AbbVie, I think it has a lot more room to run, and I'd be stupid to sell it now. Because, I mean, think about it. Like, selling it now would be like selling it back when I bought it. If I just wanted it for the acquisition to cash in, say, $1,000, that's dumb because now I'm sitting on a 90% return with a $7,000 gain, a $17,000 position because I was patient and believed in the company long term. So I don't want to get bitten in the ass for making short-term moves when I want to be a long-term investor. I've done that in the past, and I did make some profit on it, but I think the real money made in the stock market is being patient, finding quality investments, and letting them compound long-term. And speaking of compounding long-term, Google is one of my absolute favorite stocks. So I do get asked a lot why I don't own FANG stocks, why I don't own Facebook, Amazon, Netflix, or Google. I want to. I'm a 28-year-old investor. I know I'm not super young, right? There are some people in the internet, financial space that are like 16 that it would be dumb for them not to own companies like this. But these high growth companies, I want to own Google for the next 10 years. I would like to own Berkshire for the rest of my life, as long as they own See's Candy and as long as they own BNSF and Geico, I want to own Berkshire. So as long as Google owns their search engine or dominant in search, and they have YouTube and that ad platform, I want to own this company. So given the fact that T. Rowe Price is going to pay me $122 and Realty Income is going to pay me $40 this month, I'm going to be buying some Google this month. I'll make sure I tell you guys when I purchase it. But as long as they own YouTube and the ad revenue stays relatively, growing at a steady clip, I'm going to be owning Google for the very long term. Next up, I touched on it with Google, but this is one of those that I want to own and I want to own for life. Guys, I love See's candy. It is my favorite candy in the entire world that I've had thus far in my life. I'm only 28. I know the world's big, but I love See's candy. I love Berkshire. I love Geico. I love BNSF. There's so many companies like Fruit of the Loom, Kraft Heinz. He owns a crap ton of Apple stock. Like, he is the best stock picker in history. And the thing is, guys, I want a piece of that. I want Warren Buffett to run my money, right? He is so good at capital allocation. I feel like it would be stupid not to own it. The issue I have right now is the price. And honestly, I love Berkshire so much, I would swallow my pride and just buy the damn stock. I don't have $400 right now to allocate, but as soon as I get, kind of back up on my feet and getting steady paychecks again, I'll buy some Berkshire. Honestly, Altria pays me $147.10. I will have enough. Once I have enough in my cash position, I want to buy Google first, and then I'm going to be buying Berkshire. So as long as they own Geico, See's Candy, McLean's, and BNSF, there's so many companies that he owns outright as well, privately through Berkshire, that I'm going to own it for life. And I want to go to the meetings. I've gone for the past 2 or 3 years, and it's the highlight of my week. Highlight of my year. So I love it. Next, we've got Meta Platforms. So the big issue that I have with Meta is they started paying a dividend, which normally wouldn't be an issue, but because of that, the stock soared. So I should have bought it back when they were having metaverse issues, and Zuckerberg was, people thought he was crazy and allocating capital in an idiot way, a stupid way, and pouring money into the, sorry, I'm rolling my windows, and pouring money into the metaverse. So I'm all for buying Facebook. I think they have a strong competitive advantage, and I love the company. I use it every day. There was just a meme going around. Facebook and Instagram were down for like 30 minutes, and it said the whole world stopped. So when you have that type of influence and that amount of pull when it comes to internet users, you know that it's a good company. So I love Meta. I'm going to be purchasing it. I would like to get it lower than around $200, but if I have to bite the bullet and buy it at $500 and then just cost down average, I'm okay with that too. Guys, I'm at the point in my investing career where I just want to honestly just buy quality and hold it for the rest of my life. And just like with Google, if Google's no longer the biggest search provider in the world, or they lose rights to Facebook or something like that, if Facebook loses the rights to Instagram or something, or a new social media makes them obsolete, that's a possibility. That is the main focal point as to why I haven't bought it yet, is because I use Facebook. A lot of people use Facebook, but I didn't really believe in it long term, given the fact that, one, Zuckerberg is very good at capital allocation. I looked into the business deeper, is really what it is. And I like the changes that he's been making, and it makes me more comfortable to own the stock long term. So, guys, when it comes to growth, I will be owning Alphabet, I will be owning Berkshire, and I will be owning Meta Platforms. I just need a little time to get my life back in order. So, guys, with that being said, I just want to say thank you so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy. Hit the like button if you think I'm dumb for not buying Meta. And I will see you guys in the next video. Take care, guys.